Before a lender ever says yes or no to your loan application, there's a whole process happening behind the scenes that most business owners know nothing about. I'm talking about underwriting, and understanding what an underwriter actually looks at could be the difference between getting funded and getting denied. I work in small business lending. I've seen this process from the inside. And today, I'm going to walk you through exactly what happens after you hit submit on that application and what lenders are really looking for. Most lenders use a framework called the 5 C's of credit. It's been around forever, but almost no borrowers know about it. Let me break each one down in plain English. Number 1, character. This sounds vague, but lenders are asking, can we trust this person? They look at your credit history, how long you've been in business, your reputation, and sometimes even your online presence. Have you paid your bills on time? Do you have any judgments or liens against you? Your character as a borrower tells lenders a story before you even walk in the door. Number 2, capacity. This is the big one. Capacity means, can you actually afford to pay this loan back? Lenders look at your revenue, your existing debt, and something called your debt service coverage ratio, or DSCR. Basically, they want to see that after paying all your existing bills, you still have enough cash flow left over to cover this new loan payment. If the numbers don't work, the answer is no, no matter how great your business is. Number 3, capital. I'll be honest, in the CDFI world where I work, capital is weighted differently than at a traditional bank. But it's worth knowing, because if you ever apply to a bank, they will ask about it. The idea is simple. Lenders want to see that you have some of your own money invested in your business. It shows you're serious and that you won't just walk away if things get tough. Even a small personal investment changes that conversation. Number 4, collateral. Collateral is something you pledge as security for the loan, equipment, inventory, real estate, or other business assets. Basically, if you default, the lender has a legal way to recover what they're owed. The specifics of how collateral works, UCC filings, lien positions, all of that, is a whole topic on its own, and we're going to do a dedicated video on it. For now, just know that the more assets your business has, the more options you have when it comes to collateral. Number 5, conditions. This one is about the bigger picture. What is the loan for? What does the economy look like right now? What industry are you in? Lenders think about external conditions that could affect your ability to repay. A restaurant applying for a loan during a tough economy faces different scrutiny than a logistics company during a boom. You can't always control conditions, but understanding them helps you time your application and frame your story better. So now that you know the 5 C's, here's how to use this before your next application. Go through each one and honestly ask yourself, where am I strong and where am I weak? The lenders who say yes aren't looking for perfection in every category. They're looking for a borrower who understands their own business and has a clear plan. Knowing the 5 C's lets you walk in prepared instead of just hoping for the best. The 5 C's of credit are the foundation of almost every lending decision, whether it's a bank, a credit union, or a CDFI. Now you know what they're looking for. In the next video, I'm going to get even more specific. I'll walk you through the exact documents and financials you need to have ready before you apply for a business loan. Because knowing the framework is one thing, having your paperwork in order is what actually gets you funded. If you found this helpful, subscribe so you don't miss it. And if you have questions about your specific situation, drop them in the comments. I read everything.